South Africa's headline producer inflation slowed to 6.3% year-on-year in October from 6.7% in September. Stats SA says prices in the factory gate rose by 0.5% on a month-on-month basis in October compared with 0.4% previously. Now, to help us dissect these numbers, we're joined by Peter Attard-Montalto, who's an emerging markets economist at Nomura International. And Peter, despite the PPI numbers that came out today here in South Africa, we also had our growth figures, third quarter growth numbers out earlier this week. And unfortunately, SA not doing too well. But on a like-for-like basis, with regard to other emerging markets, how do we fare?
Well, the growth numbers are definitely a little bit of a disappointment. There was a lot of backward revisions, which meant that actually, if you delve into it, there's not necessarily a news story emerging, one of slow consumption growth, particularly a slowdown in manufacturing due to strike action, and mining, which had a relatively clean quarter, at least versus last year, being able to bounce somewhat back. But as you say, versus other emerging markets, South Africa doing a little bit better than somewhere like Russia, which is seeing more of a dramatic structural slowdown as its economic model shifts away from commodities, but not so good as versus Brazil, which did quite a bit better at over 3% for Q3, even given that it feels like a very slow rate in Brazil. But I think the broad message, even looking at China as well, is that most of these economies, including South Africa, are having positive growth rates, but that versus what they need to have to develop, it still feels quite slow.
Just on that, you touched on mining, and we also know that manufacturing was once could potentially still be one of the strongholds of the South African economy. And in contrast, in China, that's a huge economic machine for them. Rather unfortunate from the South African perspective, I take it.
Well, we're definitely seeing some external slowdown in demand from China coming through to the South African economy, but nothing dramatic. We're not anywhere near a hard landing scenario in China that would have a more drastic impact on the South African economy. If we look into next year, it looks like the Chinese authorities can sweep under the carpet the off-balance sheet investment and banking sector problems that there are in China for another year. So perhaps that's a 2015 or even a 2016 year worry that we should have, not an immediate worry through into the South African economy.
But Peter, I mean, if you say they're sweeping something that could potentially be damaging to their economy, that certainly would have knock-on effects to South Africa's economy. Certainly we should be looking at what that would mean, because 2015, whilst it might seem far away right now, certainly won't be next year.
Well, I think it feeds in generally to the vulnerability type analysis that the market does do, and is particularly looking at with taper just a couple of months around the corner. So it is things like, what are these linkages into these long-run structural stories around China and slower long-run growth in China and Asia in general as well. And that's where South Africa does actually come out wanting. South Africa has one of the highest levels of total economy exposures into China of any emerging market. Only Brazil is slightly more exposed. So it definitely, that sort of vulnerability analysis is important, even as you say, the risk is still somewhat far away.
Another factor that's a huge negative on South Africa's economic growth is labour. And when you take a look at comparison with regard to other emerging markets, do you see a similar stance where there's power with regard to trade unions and labour in those markets?
Well, we're seeing some of that debate going on in Brazil at the moment, but it hasn't really boiled over, if you like, to be as disruptive as in South Africa. Equally in Russia, I mean, they're seeing a lot of pressure to boost economic growth, but that's mainly coming through capital injection, not through increasing employment or anything like that at this stage. So South Africa still stands out as being somewhat unique in terms of quite the level of market focus and event risk that there is around labour. Having said that, I think looking back at 2013 has been relatively quiet actually versus the sort of post-Marikana expectations we set. Sort of our expectations at sort of the worst possible level, which were ultimately disappointed by a more quiet labour market. I think that changed into Q1 of next year when we have a coordinated or likely coordinated AMCU strike to start the year in the platinum sector.
I mean, Peter, if you had to step away from, I suppose, the issues on the day. We know Northern is certainly in the spotlight right now with its wage deliberations with the National Union of Mine Workers. And look at what has transpired in South Africa with a lot of questions around the power of labour. Looking into 2014, do you think the labour union movements will have more or less power going into next year?
Well, I think they're definitely weakened as a force, both politically and structurally, given now the passing of the legislation before Parliament, rather, the youth wage subsidy, labour broker regulation, not banning them at this point either. And I think they are definitely weakened and have lost a number of battles with the ANC on that front. Of course, the talk of split as well of COSATU and NUMSA and the rise of other unions, I think, further weakens the hand of us on the policy front, though of course it means that we can potentially get more disruption going through next year. I think the interesting question is, can the ANC actually break free of the unions after the election in terms of policy? I doubt that. I think they're still too wedded to the tripartite alliance and the historical implications of that. But it means there's still a little bit more wiggle room potentially on policy. Not necessarily a dramatic shift to the right into free market policy, but perhaps a little bit more room to try and boost job growth by the government after the election.
Peter, you touched on the elections, and from a global perspective, we're expecting tapering to kick in. Some say in December potentially. You expect as early as Jan, but just exactly how might that impact on foreign investor sentiment with regard to emerging markets like South Africa?
Well, it's an interesting comment. You said in your introduction around markets perhaps now viewing taper as a little bit more of a positive event, as a signal that that global growth and particularly US growth was recovering, and that reflects some of the sentiment that Lesetja Kaganyago was saying yesterday, Deputy Governor of the SARB. And I think we shouldn't overplay this too much, actually. I think in general that sort of more positive mood music around taper means that markets will not focus on a generalised emerging market crisis, for instance. It means money can still flow into emerging market funds, but vulnerable currencies, particularly like the rand and others in the fragile five like Brazil and Turkey as well, are still going to be put under intense focus through taper, will cause a lot of volatility. But having said that, I think it is priced into the market to some degree. So we see rand weakening through taper, perhaps up to 10.50 or so, but not some massive breakout crisis up to say 12 or above or anything like that at this time.
Well, many thanks to Peter Todd Montalto, emerging markets economist at Nomura International.